My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to make you some money. My job is not just to entertain. It's to teach. Put days like today into context, because I know you need it. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Forget no country for old men. This is no market for young investors, including today, where a hideous tech sell-off ultimately crushed nearly everything. The Dow sinking 35 points, a huge decline when it was up 300 points, while the S&P plunged 1.04% and the Nasdaq, weak from the get-go, plummeted 2.55%. If you're a grizzled veteran like me, this market's pretty straightforward. But for the younger demo, it can be both confusing and terrifying. And tonight, I'm going to change that. Tonight, I'm giving younger investors my handbook of what did just fine in this hideous tape and why those stocks will keep winning, along with why the stocks that are melting down will likely keep melting down until they merge or trade at levels too low to be believed, or for something that makes the selling stop. I dare not know what that be. I say this is a market for grizzled veterans because if a company's only been publicly traded for, say, let's be arbitrary, a dozen years, it's most likely getting crushed right now. These modern stocks have become what we call in the business sources of funds. Sell, sell, sell. And that's what drove today's sell-off. Sources of funds. It includes many stocks in the Nasdaq where it got really ugly today. There are so many of them, and they've become untouchable for now. Even if the underlying companies are doing well, and we've got two on tonight that they are doing very well, the stocks have become so awful that by the end of the day, they've managed to drag down nearly everything. Of course, it's not just the Nasdaq. If you're in the semiconductor business, the chip business, and your stock trades on the New York Stock Exchange, it's been annihilated too. Remember, I showed you Frito-Lay chips and a semi-chip. One tastes a lot better than the other. Look, I'm going to talk about what's wrong with those stocks later in the show. Right now, I'd rather focus on the groups that are working because you know what I say at the end of every show. There's always a bull market somewhere. When I say the losers have become sources of funds, we have to talk about where those funds are going. Where are the remaining bull markets? Remember, 40% of the S&P was up at the beginning of the day. That wasn't the case at the end of the day. And in a bad tape like this, the stocks that work stick out like sore thumbs. Let's go down my sore thumb stock list. Little cinema verite. Okay. First, if a company mines or extracts minerals, then as long as it's not a SPAC play like MP Materials, its stock has been roaring, even if it got hit this afternoon. Alcoa's going from $5 to $41 in just over a year. Their aluminum's used to make cars lighter. Freeport-McMoran surged from $9 to $42 in that same period. Their copper's used to build everything, especially, though, electric vehicles, which can use up to $200 of copper per car. So it's a good time to be in the copper business. There's not enough of it. These raw materials companies are second nature to an old guy like me. I remember when Phelps Dodge that used to be the biggest copper company. But younger investors probably haven't spent much time thinking about all the things that aluminum or copper go into. Look, I don't blame them. If you came of age after the financial crisis, you had no reason to think about Alcoa or Freeport whatsoever. And a decade of stagnation, who would ever worry about them? But the economy's booming now. And this is what works during a boom. And you have to understand that a boom drives you out of some stocks and into others, even though they're boring. And same goes for the oils. I don't care for the oil industry in general, but there are two that I'm willing to recommend. If you want a big dividend, I trust Chevron more than any other. If you want growth, I like Pioneer Natural Resources. I know the management well. They're terrific at finding oil. I can't blame anyone who wants to avoid fossil fuels on principle, but you have to know why their stocks are roaring here. You need to see that these are demand-driven, meaning that customers are desperate for their products. Then there are the infrastructure stocks, obviously, because we have an infrastructure bill. If you own anything steel, meaning anything that can be used to make steel or move steel or dig holes and take minerals out of the ground, then you got a winner. Caterpillar's the best of the bunch. A decade ago, they bought a mining company, Bucyrus, and that acquisition's finally paid off. It's mining equipment. Plus, they make everything you need to build new highways. Deere has lots of agricultural exposure, but its machines can dig some terrific holes and move a lot of dirt. United Rentals has a ton of machines. They're renting them, hence the name. Next up is a company that builds houses. It's stocks that can find buyers, whatever you say. I mean, we can find them for you, okay? And that's the demand from housing that has to do with moving from the cities, and it's off the charts. Between low interest rates and the COVID-driven exodus from the cities, you aren't going to be able to find a nice house that doesn't have multiple bidders, meaning you have to pay more for it than you thought. So you just borrow the money, which, of course, is cheap because the Fed wants to keep the economy moving and create jobs. And that means Lennar, it means Toll Brothers, it means D.R. Horton. They're all loved. And that love extends to anything related to home improvement and home furnishings, which all have amazing demand. Let's do Williams-Sonoma on the high end, Wayfair on the lower end. How about Lowe's and Home Depot, both of which are getting a boost from this excellent gardening season, by the way. Stanley Black & Decker, we had them on. Remember, they sell goods and tools that renovate. People don't like the quarters, up 10 points. Best Buy, yes. How about a home theater? All winners. If a company makes a consumer product and has a good enough brand name that it can raise prices to pass on rising costs, that's a winner, too. Think PepsiCo, think Coca-Cola, Procter & Gamble. And by the way, thanks to a weak dollar, it just hit a 10-week low. These are even more attractive because they're now more competitive overseas. Plus, they've got good buybacks and good dividends, so they get support on days like today. If a company takes goods from one place to another, particularly steel, you have to have something worth buying. Right there. Moves it from here to there, I'm a buyer. J.B. Hunt, Norfolk Southern. Cummins for the engines in the trucks. A bank. Any bank. Why? Because banks are being reviewed by the government, and if they pass these so-called stress tests, they're going to get to buy back stock and raise dividends. The financials are classic early cycle names. They tend to make big money when the economy starts booming. Mall stores, incredibly, are back. Simon Properties, good number tonight. But what I'm looking at is L Brands, American Eagle Outfitters, Gap. That's that lag trade, as suggested by J.P. Morgan ace analyst Matthew Boss. Your stocks did just fine today. If a company does anything in agriculture, whether it be Mosaic for fertilizer or Deere Agco, one of our faves, well, it's a winner. With all sorts of crops selling at all-time highs, you want to be in this business. If a company makes chemicals like Dow or DuPont, they're making big money. Demand is strong, but more important, supply is limited, often because Winter Storm Uri took out so much capacity. If a company's in the drug business and it has a dividend and it's storied and it's got a buyback, its stock will attract buyers, even if it's not a particularly good drug company. The market has no problem with mediocre houses and good neighborhoods these days. So what's the commonality here? All right, let me spell it out. The stocks that held up today are the ones that belong to companies with products that are in strong demand while supply remains limited. Remember that EC10 class you took? You can say the same thing for the stocks themselves. More buyers than sellers, as they say on Wall Street. It's become a supply and demand market, not a market share market or a land and expand market or a total addressable market or a go-to market. Too many younger investors only know what they see in their cell phone. They know apps and games. In some cases, they know short positions. But they don't know what's right in front of them. All this iron and steel and aluminum machinery, in part because those stocks spent years lost in the wilderness. And now they found Canaan. But the bottom line, with a booming economy, everything new is being sold, while the old school companies with products that are in short supply also have stocks that are in short supply, which is why they held up so well in today's onslaught and why I think they'll keep climbing, even if everything else keeps going down. So, buy the sore thumbs. Write them down. Take a picture. Snap a picture of us. These are sore thumbs. I'll throw in some steel if you want to, because the others, well, let's just say you got to wait till the coast is clear.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.